You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Bupp here with episode number 146 of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guests for this week's show are multifamily and commercial real estate experts and syndicators, Thomas and Tim Black. And in today's show, we're going to be speaking with Tom and Tim about how they got their start as multifamily investors. In fact, they both took very different paths before finding themselves knee-deep in the multifamily space. Tom was an emergency room physician, and Tim, a CEO for a national resorts chain. But as we'll both tell you, getting to where they are today wasn't an easy road. And here's what you're going to learn in our show today. You're going to learn how Tom got his start as an emergency room physician prior to diving into multifamily in a very big way. You'll learn about the lessons he learned from his very first multifamily deal, which was a ground-up development of a medium-scale complex. You're going to learn how he used the 1031 tax exchange code to parlay his equity from his ground-up apartment development into multiple other cash-flowing assets, completely tax-free. You'll learn how Tom has built an extensive database of high-net-worth investors by focusing on educating doctors and medical professionals on cash flow real estate investments. You'll learn what his investment horizon looks like with regards to how long he likes to hold his investments and why. You're going to actually learn how he structures his syndications and his various partnerships that he has. You're going to learn about the importance of relationships and why you need to be continually cultivating relationships with key brokers and property owners alike. You're going to learn about the importance of analyzing deals and making offers on a regular basis and why the odds are in your favor of finding a great deal on the more deals you analyze and the more offers that you make. And much, much more. And guys, if this is the first time you're tuning into the show here, just want to welcome you to our incredible family that we have here at the Real Estate Investing for Cash Flow podcast. Or if you're one of the many that come back each and every week, the thousands of you that come back each and every week, just want to let you know how grateful I am that you've been sticking here with me, okay, for all these years now. And just grateful for everyone that's here. I wouldn't be here if it wasn't for you. And just a few laundry list items I'd like to run through with you before we get on to the show with Tom and Tim. And trust me, you're not going to want to skip forward here. I know some people like to skip forward with these little introductions I do, but these are different, a little bit different here today. So don't skip forward because there's some great updates here. And the first one, if you're an accredited investor who's looking for a passive investment opportunity with a team of experienced operators, and I want to take a quick minute and I want to tell you about the opportunity to partner with me and my team at Sunrise Capital Investors. And in case you aren't aware, I specialize in the lucrative niche of mobile home parks, and we're currently looking for investors who are seeking above average returns to partner with us on deals. Now, based on historical performance of our existing portfolio of mobile home communities, we are projecting a 20% or greater rate of return over the life of the investment and 12% annualized cash-on-cash returns to those who partner with us. And I'm going to tell you this, based on our existing portfolio of parks, we far exceed those returns I just mentioned. Now, I can't guarantee it, but I can tell you that we don't buy just mediocre deals, okay? We know how to hit home runs and we know how to find them. We currently have 5 parks in contract to close and have multiple others that are in the pipeline right behind it, and we're looking for serious investors who want to partner with a winning team. Now, I will tell you that I personally have my finger very close to the pulse on the various other investment offerings that are being offered in the marketplace, whether it be multifamily or commercial, and I haven't seen any that can hold a candle to the opportunity that we're offering, okay? If you have serious interest about getting your money to passively work for you in a very big way, then we should talk. You can get more information on our company and download our investment prospectus by going to our website, sunrisecapitalinvestors.com, or just by calling us, 888-260-9455. We have a secure investor portal directly on our website where you can download and review all of our investment material and see if it might be a good fit for you. Again, visit our website, sunrisecapitalinvestors.com, or you can just call us, 888-260-9455. And just another quick thing that I want to mention. We have a large majority of investors that are taking advantage of investing with us through their self-directed IRA. So if you currently have a retirement account that isn't performing up to your standards, then again, we should talk, okay? We partnered with Advanta IRA, which is a local company here in the Tampa Bay area. It's actually the same exact company that I use for my own self-directed investments, and they're here to answer any questions for you, okay? In fact, we've even created a special landing page, which I'm going to place in the show notes, and that landing page is info.advantaira.com/Sunrise Capital. Now, I know this might be hard to remember as you're driving your car or jogging down to the beach, listening to this podcast. And so you can just grab that website for the self-directed IRA information directly from our show notes. Or again, you can just reach out to us directly by going to our website, sunrisecapitalinvestors.com, or you can call us. Pick up the old school phone and call us, 888-260-9455. And just another little added surprise I want to mention. I know that there might be a large majority of you who are listening right now who are seeking a more active investment, okay? You don't just want to sit back and passively collect 20% returns on your money, and I actually get it. I mean, I'm the exact same way. I mean, I like to get my sleeves dirty. I like to dive in and get my hands dirty and actively work on the investment, not just sit back and relax. Well, if that sounds like you, then we have a special offer for you. For any person who invests with our company at sunrisecapitalinvestors.com, we're offering a lifetime access or lifetime membership to our flagship Mobile Home Park Academy training program. In the Academy, you'll learn all the mechanics of the mobile home park investing business and have the opportunity to be taught directly by me and my team. Now, this provides those individuals who want a more active role the firsthand experience of the internal workings of our very own mobile home park business. So not only will you get to participate in deals with us, but you also have the opportunity to learn the exact systems and processes that we use in our very own business. So maybe one day comes along, you want to go out and do your own deals, right? You want to get your hands dirty. You want to get active. If that's the case, then you'll have all the wisdom and knowledge necessary while simultaneously partnering with a team who has a proven track record. Again, you can connect with us and learn more about the opportunity by going to sunrisecapitalinvestors.com. And if you want to learn more about the academy that I was just mentioning there, you can go to mobilehomeparkacademy.com. We have a dedicated website there for the academy. We have a podcast that we do weekly on mobile home park investing. So if you actually have any interest whatsoever in mobile home parks and think that it might be a niche you want to explore, number one, you need to be listening to that podcast. Number two, you need to actually go to that website, read about our academy, because it might be a great fit for you. Whether you invest with us or not, if you're interested in this niche, go check out the academy, because it is by far the most comprehensive training that you're ever going to see in mobile home park investing, okay? And lastly, guys, if you happen to be in the Tampa Bay area, I'd love to meet you. I love meeting others that are traveling through that share a passion for real estate investing. And so I've met with probably hundreds of you so far over the past couple of years. And so if you're in town, you have some extra time, you'd like to get together, shoot me an email directly. My personal email address is kevin@kevinbupp.com, and we'll do our best to coordinate a time to get together, okay? Love meeting others that share the same passion as I do and would love to meet with you. And now, guys, that's all we have. So let's get on to the part of the show that you've been waiting for, which is our interview with Tom and Tim Black. Here we go. Tom and Tim, welcome to the show. How you guys doing today?
I'm doing great, Kevin. How are you doing?
Good to be here.
Yeah, I'm excited to have you guys. You guys have been making waves in the past couple of years in the multifamily space, and so I'm very interested to dig deep and to find out a little bit more about your business model and why you guys chose multifamily as the investment vehicle of choice. But before we dive deep into the weeds, I'd like to learn a little more about your background and how you guys got into this business, because you guys have a very you both took different paths into the real estate game, and it's quite an interesting story. So maybe if each one of you would just take a few minutes and tell our listeners a little bit more about yourself.
Sure. So I am the younger brother of the two, Tom Black, and so I was a less than stellar high school student a number of years ago, and chose to enter the Navy at age 17. Saw the world, did numerous deployment overseas during the first little Gulf vacation that was happening in the early 90s, and really decided when I was in the Persian Gulf at one point that I wanted to become a doctor. So called home and told my parents that the kid that barely graduated high school was just going to get out, go to undergrad, and go to med school. So ended up doing that, oddly enough. Went to undergrad, studied biochemistry and some business aspects. Got into med school and really had my head down for, as you can imagine, a number of years. And at the end of that time frame, which is probably a better part of a decade, I was coming out of residency, and right about this time, the economy and real estate was hitting an all-time low. And unfortunately, I purchased my house when I was in residency at the peak of the market. So my wife and I decided to rent it to another incoming resident for a number of years. And I started reading books and and really for the taxation, because I knew where I was going after residency was going to be moving back to Texas, and just got completely enamored by real estate, and began buying houses in my first practice. Was buying houses down in the Houston market, probably about 3 hours or so from a level 1 trauma, or level 2 trauma center that I was working at. And worked there about 5 years while doing real estate on the side. Really loved single family, but then bought some land and had a partner at the time, and actually developed an apartment complex from the ground up. Did very well on that, and 1031 that into a bunch of commercial assets. And about that time, I realized that I really, really loved real estate, and actually resigned. I was a full partner in my practice, and I resigned, and we moved 3 hours west to the Dallas-Fort Worth area, and really started getting deeply involved about 4 years ago in the Dallas market, and have just done very, very well, and enjoyed life immensely, and have really taken it upon as part of our practice and our firm to educate not only professionals in medicine, but dentistry, attorneys, basically turning high-income professionals or high-income folks to educating them to what a high net worth really is, and how that can really save your career and make your family life much more enjoyable. So
okay,
that's me in a nutshell.
And I just want to be very clear here before we move on to Tim, your background. And so you basically no prior development experience. You basically developed a multifamily property, and you hadn't even owned a multifamily property yet, but yet you dove headfirst into a development deal, and it went well, which is awesome.
Yeah, I had 3 acres of foreclosed land right in the middle of Longview in East Texas, and didn't know what development was, and I knew it was zoned appropriately, but man, you got into the Schedule C of the title work, and there was, in East Texas, it's like a basket weave of pipes under the ground, and of course, who thinks about pipes as zoning and everything else, and so it was a challenge, to say the least, to build the buildings we did. So yes, I thought reading the books is like any normal doctor thinks he's the smartest guy in the room, which is not the case at all. Dives headfirst into a pool without water.
But you made it out without a broken neck, right?
I did make it out without a broken neck.
Yeah, fantastic. And Tim, how about yourself?
Yeah, so my path probably couldn't be any more different than Tom's. Well, he had his hands inside people in the emergency room. I had my hands on roller coasters. I spent 18 years with Six Flags theme parks, was park president for several other properties, mostly on the East Coast. And then about the year 2000, the company wasn't performing very well, and after 18 years of that business, not being able to see my kids in the summertime because I was at work, I decided to make a pretty big career move, and I went to work for a company called Great Wolf Resorts that owns about 14 indoor water park resorts, very large-scale resorts across the country. I was the chief operating officer of the company. When I started there, we had about 6 properties, and then when I left just over a year ago, I retired. We opened up the newest property in Anaheim, California, and fortunately, for me, I've been very fortunate in my career. We sold the company a few times, which gave me the opportunity to, after 31 years in entertainment and hospitality, to do something different. So I took about 6 months off to reflect and think about, what the next stage of my life was going to be. And over the course of many, many years, obviously, have been listening to Tom and following Tom. And, you go back to the 3 acres of foreclosed land with pipes underground in Longview. He took me out there one day, about 10 years ago, and in his big giant pickup truck, and said, "Dude, I'm building an apartment complex here." And, I looked at him, and the first thing I said was, "Do you need your head examined?" It seemed incredibly risky, and why would you do that? And, being a young father of 4 kids and, a big time career, treating critically ill patients, I couldn't quite understand it. But I think that was probably, a breakthrough for him, and certainly a breakthrough for me as I watched him build this thing. And, we kind of joked because the management company was our parents, and I remember them visiting us and answering the phone and leasing out, apartments. But, I think what that did for me, number one, is it kind of said, man, you can really have 2 careers. And this was so different for Tom. And I started thinking a little bit about it. And it's been, really a very good partnership since I retired. And, There's many similarities in the term of, we were developing large scale real estate resorts. So I have, a lot of experience in that area. And there's many similarities to multifamily in the terms of apartments or rooms and hotels or rooms. So it naturally made sense to me. I've been keenly interested in real estate. We've bought and sold a lot of houses because I moved with Six Flags a lot. And Tom's laughing because we have a couple houses right now that we own, and some of them we rent out, some of them we don't. But the tax code obviously, it incentivizes. Obviously, the government incentivizes people to invest in real estate, and I have learned a lot the last year, from books that Tom's been shoving to me, and looking at various resources out in the market, just about those opportunities. So you couldn't say our paths are
very different
at all, but
very different. You were out playing on roller coasters, and Tom had his hands inside of patience.
And let me just say, Kevin, with my parents at the management company, they were retired and they're of advanced age, and they lived very close to me. They moved there, and so they desperately needed something to do.
Oh my God! So they really were the management. You guys aren't joking around.
It was a win-win situation. Okay. No, so Tim likes to mess with me about that, but yeah, that is the absolute truth.
That's hilarious. So I want to touch a little bit on this development deal, because it really sets the foundation. I know that you guys had a couple other investments prior to that, but I mean, this really sets the foundation to where you guys are at today. And I know that you're not, and maybe I'm incorrect with the statement, but I don't think you haven't developed any multifamily since that point in time. But still, that is the foundational stage, and it's probably a lot more challenging developing than it is buying existing, which you guys would probably agree with me on that one. But let's
100%.
talk. let's talk about the development side. First and foremost, everyone, whether they admit it or not, or whether they even know it, everyone's got different mentors in their lives. I mean, some might be books, some might be individuals, partnerships, whatever it might be. So, talk to me about the path, Tom, that you took with that development deal. So you bought the raw piece of land. I mean, did you initially have the intent when you're buying that raw piece of land that says, hey, I'm going to develop this apartment complex? Or were you just buying the land because it seemed like a good deal and you're like, well, I'll figure it out down the road what I do with this. Maybe I'll flip it as raw land. I'll just hold on to it.
No. I totally bought that land specifically to build an apartment complex. Okay. I mean, it went through several permutations, and how it went, it was probably, 2009, somewhere in there. And I knew that I had a custom home builder that had built an outdoor kitchen in my house. So I'm literally a year out of residency, and I was getting restless already just because I was working too much in the ER. The satisfaction was very different for me, and I needed some sort of a distraction. I'm one of those people that I finally come to realize that homeostasis for me and just sitting around does not work. I get super restless, and I'm only really, really happy when it's absolute chaos. Mm-hmm. It's just where I fit into, and I always complained about that for years. Why are we always doing this? We always have too many things going on. Well, it took me a while to figure out, well, that's just me. So bought the land. It was a foreclosed piece of land. It was actually adjacent to another apartment complex, and I went to this little podunk bank that was a number of miles away that held the note, and found out that it was zoned, MF2, and what we could do with it. Bought the land, and I'll never forget closing on that note. Was the president of the bank was sitting across from me, and it was only $30,000 for a couple acres, like $35,000. And I'll never forget the words he said to me, because I'm apprehensive about the whole thing, and here I am partnering with a custom home builder. He just says, in his old East Texas drawl, son, you're going to make money. You may not make as much money as you want to, but you're going to make money on this deal. I said, okay, well, that's reassuring. So took those words to the bank. It didn't happen as fast as I wanted to. You can imagine all the issues and the pre-development. Zoning wasn't an issue, but utilities. I mean, everything from, there needs to be a fire hydrant every 600 feet according to city zoning. Once we got started, we had 90,000 or something square foot in two of these buildings. Well, anything over 6,000 feet in that city, the city ordinance the year before had passed that you had to have sprinklers for fire. So it's like, oh God, now we're going back and we're putting in this huge fire system that I didn't account for in my budget, and you learn so much by doing, and it was an absolute education that I'll never forget. Just like you alluded to, I would do it again if I was in bed with somebody that that was very good at development. But, for that size of a project, it worked. And my partner, Steve Oram, and I, who's actually a firefighter in East Texas, has just done, it was phenomenal.
So you didn't really have a consultant or anything you brought on board. I mean, you had your outdoor kitchen builder that had done a few projects. He had pulled some permits over his time in the business, but nothing to this extent. And so it was really a learn as you go. Very interesting.
Yeah, it was, and it was. We figured it out. We had a draftsman, not an engineer, do any of that, which is there for another item that I learned that I needed to. Engineering is very important. And so, we just did it. And I had read numerous books, of course, Rich Dad, Poor Dad, a lot of the Ken McElroy books, things like that. I read, I was voracious about anything multifamily. But it was either that or duplexes, and I figured, hey, if we've got the land, we can maximize here. And what turned out, because when I moved there, one of the big impetus for me to build this was there was nothing built after probably the mid-'90s as far as apartments, and all of them were 100% occupied. I mean, there was wait lists in East Texas for these things.
Wow.
And so they were renting for $1.20, sometimes $1.30 a square foot for C-class apartments, and not to mention A. And so I said, hey, we're going to do this, and it took us about a year to develop, and by that time, some of the larger plots of land had started, booming. There was about another 1,000 units added while we were doing this. And so we had it. We only held onto it for a short time, and we sold it right at about the peak, which was good. But these things were nice. I mean, they were like homes, and you can imagine I had to rein in a custom home builder. I mean, granite, stainless steel appliances. I mean, just totally over-engineered the thing, but still did very well. So I look back and think, dang, I should have put about 9 more units on that thing, and made them half the size, and they would have been fine.
And so, what were you guys getting per foot? Like $1.60 a foot then, and when it was all said and done?
No. We were probably $1.15, right around in there. But our build cost was so inexpensive. We had done everything. We bought materials by train car. Because we had so much wood and everything else.
So help me understand that. So you said some of the C-class were renting for $1.30 a square foot.
The A, I would say that the C-class was renting from
I misunderstood. Okay.
And the A class, the brand new stuff was going in.
Gotcha.
Was getting like $1.60. Yeah.
And so you guys held on for a few years, and then you 1031 that into another opportunity. And so give me the time frame, because like a lot happened in between 2008 and to where we are today, right?
Oh yeah.
So give me that. You said you started that project 2009. Is that correct?
Yeah, we sold at I want to say 2012, late 2011, probably 2012 is when we sold. It took us a year to develop, and then when we 1031 that, there was a industrial park that is on the main thoroughfare through I-20 in East Texas, and there was got to know the developer very well, and so what we did is we developed 2 kind of light industrial oilfield lease company facilities. And those have 10 to 12-year triple net leases on them. We had companies come in from Utah and actually overseas, and so it was a much different kind of an asset, but it served us well because right about then that was when kind of an irony that oil started to drop significantly, but oilfield service companies, you still got to maintain the wells, so they weren't pumping, but the certifications and the wellheads still had to be certified in order to do this every 2 years. So those companies didn't change, just the drilling companies. So we weathered that well. And then when the economy changed so much from oil, those apartment complexes took a fairly large beating because the jobs were leaving that area. And so we were fortunate to have sold it at the top.
Okay, fantastic. So I want to bring everyone up to speed where you guys are at today. I guess first start off by, you guys are buying pre-existing apartment complexes now. That's your business. You're still in the multifamily space. I want to better understand what your overall investment strategy looks like. Like, for instance, like what kind of fundamentals you look for when out seeking a deal, like size, class of property, occupancy, price points, the market that it's in, and just kind of give us an overview of your general business model today and what it looks like.
Sure, Tim, I'm going to let you feel that one since I talked for about 40 minutes there, it seems like.
Yeah, no problem. That's great. So, listen, let me talk quickly about the market. So, we're invested in Dallas and Fort Worth. We have properties in Tulsa, Oklahoma, and then a couple small properties in Madison, Wisconsin, which is where I live. So we primarily are investing in B and C multifamily assets. We love the Dallas-Fort Worth market. I mean, arguably it's the most electric economy in the country right now. Mm-hmm. There's just a lot happening in Dallas. But what's happened also is it's just really put significant pressure on cap rates. So the core fundamental of our business plan is to develop and cultivate a few new markets. So we have spent a lot of time in Atlanta, Georgia. We have a 284-unit property, Class C plus property that's under contract in Atlanta. We're cultivating Charlotte, North Carolina, and Indianapolis. So we like those markets. We feel like Atlanta is 18 to 24 months behind kind of where Dallas is today. There's a lot happening in transportation. When you think about the Hartsfield-Jackson Airport and logistics seem to be, a growing part of their economy down there. There's a lot of new jobs coming in. I think Amazon's building a significant amount of warehousing. Obviously, Home Depot, headquartered there, they're spending a significant amount of capital on their online business. So a lot of exciting things happening there. We look for properties that will return on a cash-on-cash basis between 8 and 12% for our investors, with 100% returned over 5 years. So 20% IRR over 5. Mm-hmm. The properties that we have in Dallas, and Tom can talk a little bit about this one in Arlington, has doubled in value just over a year and a half, which doesn't happen very often, and quite arguably probably won't happen again for a long time. Mm-hmm. So, those assets we're looking for are value add, have some meat left on the bones. We like finding properties or acquiring properties that, either have had very few or no interior upgrades. The property in Atlanta, for example, was built in the 70s, and they've never done any interior upgrades or renovations. So part of our business plan is to upgrade 65 of those to create, additional rental growth opportunities. Add new amenities, whether it's covered parking, reserved parking, outdoor grilling areas, just make the communities more enjoyable for our residents, mm-hmm. which ultimately, returns higher returns for our investors.
Okay. And then give me an idea of the general size you guys are looking for. What's the minimum? And I guess there's probably no maximum in size, but what's a minimum that you'll consider? Yeah,
no, great question. So, we typically look for deals that are, between 5 and 20 million. That's kind of in our comfort level. So, depending on the market, 100 doors to, this Atlanta deal's 284. So, 300, 310, 315. That doesn't mean that, we've looked at many deals that have been kind of above 20 million. We have a, very robust, active investor database, that Tom has cultivated. I know we're going to talk about that, Tom has developed and cultivated over the years that, probably 90% of our investors are physicians who obviously have high net income, but it doesn't translate to high net worth. Mm-hmm. So, those are kind of the deals that we're in our sweet spot.
Okay. And I want to clarify something, because those that are just maybe looking to enter into this space, I feel like the words value add and the words distressed and opportunistic, I mean, like they get thrown around, interchangeably, right? And they're all different. They really are. And so you guys are value add investors, but that doesn't necessarily mean distressed. I feel like those two terms get thrown around interchangeably all the time. They're very different from one another. And you guys are more... Right. Stabilized, value-add stabilized type investors, correct? Where you're more so just doing upgrades to units, but you're not buying necessarily apartments that are complexes. And correct me if I'm wrong, that are 80% occupied, where you've got 20%
correct. No, and that's what I would That's what I would lay down as exactly what you said, is a distressed asset. If there's significant occupancy and issues, significant deferred maintenance that is going to require a lot of more intensive defensive issues, and then you've got different financing that comes into play with that, mm-hmm. and that's not where our model is. I mean, I would say we're value add if there is some to be had, just with light modifications to almost a straight yield play. which is essentially just buying the asset and continuing what the current owners have done.
Okay. And so you mentioned you're looking for 100% IRR in 5 years. Does that mean an actual liquidity event of a sale, or are you guys just looking to refinance? Or I guess a lot of that has to do with the debt you put in place in the front end. And so maybe I should ask that question first, as far as what kind of debt you're financing with. Is it, and if it's Fannie Mae, Freddie Mac, then you're pretty much stuck in it for 10 years. So what does the front end look like as far as the financing terms?
Well, it's mostly, like you said, agency debt, Fannie Mae, Freddie. But depending on our exit strategy, I mean, what we look at is tend to look at things in 5-year aliquots. So, year 5 is where we underwrite for. But certainly when you deal with Freddie and Fannie, we tend to take that 10 to 12-year note just because we want to mitigate any risk that's going to happen within that 5 years that we can ride out, and have a decent cash flow for our investors. Because at the end of the day, let's be honest, that's where Tim and I are very, very passionate about educating, number one, and creating an investor relationship that they are our first priority. And I don't feel like, bridge loans, things like that are just not our niche. I want to mitigate that risk, and I want a long runway in case there's something that does happen. And so, yeah, I think that we've got several different options. If you were to take example of an apartment complex I bought in 2015, it's done very, very well in this DFW market. We put a Fannie loan on it. We're only 18, 19 months in. The yield maintenance on it is very, very steep. I think in the order of $1.5 million prepayment, something of that level. But we can continue to ride out that cash flow. It'd be great, but it is not to say that we couldn't put a supplemental on and sell it as a supplemental, or that the numbers will work. I mean, we just got a broker's opinion of value for right over $22 million. We bought that for just over 12.
Wow.
Right. Yeah.
That's fantastic.
So, and it is not indicative. I mean, that's part of the thing. We have to temper some of our investors' expectations, because that's not the norm, right? I mean, lightning does very seldom strike twice in one place. You don't normally double your money in 18 months. That's just not heard of. So, you've got the good with the bad, but there's all sorts of different options, supplemental, and then of course, any yield maintenance. But we typically look at 5 years and underwrite for that, with the norm that we're going to probably go beyond that if we need to.
Yeah, so I want to talk about that a little bit, because we just launched the fund about a month ago, and so but we have long-term horizons. Like anything we buy, and we're in a completely different business than you guys are, but at the end of the day, we're really all about catering to our investors, right? And we want to find the investors that are the right fit for us, for our business model. Right. And our business model is to, just like you guys, get our investor capital back as fast as possible. But with that being said, our long-term goals are to hold on to our assets. Now, everything is for sale at the right price and at the right timing, but I mean, we're cash flow guys, and so our intent is to get the cash, the investors' cash back to them, but then to hold on to these assets for the long term, minimum 10 years. And so, like, we're a 10-year horizon, and we typically just let investors know, like, if that's not the type of ride you're looking for, then we're probably not a good fit for you. And what's your outlook? I mean, are you guys long term? Do you look to hold these things for a period of 10 years plus, or are you looking to exit out once that loan has run its term?
Well, it really depends on the asset. When we just closed on a commercial property last month, and there's a triple net triple net asset that was leased out of a company from actually in California that has, Tim, 8 years left on their lease. And so the way we look at that is it's a different investor. The investor that's going to want to go in and get out, we figure we'll hold on to it for, 2-3 years. Everybody gets probably a guaranteed roughly 15%. We've got a 12 pref on that. We'll pay out. And then with reversion, they'll get a little bit more. That kind of a thing, I know I'm going to sell probably year 3. I really want to leave that lease long enough so that somebody else comes in. I mean, I don't want to be negotiating lease, because that's not where our strong suit is.
Right.
But when you look at an apartment complex, absolutely. And one of the biggest things, and that's where you have, depending on the asset, what it looks like, if it's a larger apartment complex like the Atlanta offering we're getting ready to send out here in the next couple of days, that's a large apartment complex with a decent value add that's going to be a great cash flow entity for a number of years. And for me, particularly, taxes are a big deal. I want to hold on to that asset as long as possible to cash flow that and to mitigate not only my personal tax, but to offset any capital gains and things like that. So, yeah, I mean, it's going to depend on the investor. And certainly for physicians, I just like to say, okay, by year 5, here's what we look like. This is what the landscape we're saying our pro forma is going to look at. But by no means does it necessarily trigger a sale. And like you said, everything's for sale and this is one of the different things we don't do. A lot of folks will put a general partner, limited partner deal together. We tend to use LLCs and a one-off LLC and not a funded deal for that very reason, because if I get Alzheimer's and Tim, decides to move to Lithuania, then we've got a backup, right? We've got people there that can take over if there was something. I always want to be held to a standard of excellence, and if I'm not being held to that, then my investors can vote me out, and I think that's very, very important.
Mm-hmm. So,
if
technically,
we'll put that out there.
It's more of a joint venture then at that point, right? Than it is a
exactly.
Okay. So you guys don't have it. You don't have it structured as a Reg D 506C or B. Then correct?
It's a 506C. It is a 506C. Yes.
Okay.
But the way I look at it is, my investors we're partners in this deal. We put our own money into it as well.
We do too.
And so I think it's just a different perception that you're investing with us, definitely, but you're also a partner in this. And if there's something that is not right, then they have that option to vote. I mean, I think that's really, really important.
Yes. Yeah. No, I agree.
And it also is scary from our standpoint, because there's a lot of different opinions out there, but I want to be held to expectations, and I think it's really important to have that.
Yeah, no, I agree with you. And those syndications that are out there don't put any of their own money in. I think that you need to be aware to a certain extent. I think that, the argument I use is that if I believe the deal is that good and I've got money laying around, why the heck wouldn't I be putting it into it, right? I mean, if the money's just sitting around doing nothing for me, and I think it's just a slam dunk deal, and I'm going to be trying to sell other people on it, why wouldn't I be putting my money into it? So...
Right. No, you're just taking a fee to close the deal, and then you're gone.
Yeah.
Right?
Exactly.
Bit of a red flag if you're not willing to invest your own money.
Yep. No,
right.
Absolutely.
Yeah, exactly.
So can you guys talk about? I know that this Atlanta deal is kind of fresh, and honestly, by the time this airs, it'll probably be a couple weeks anyway. So you guys probably should be already closed on it by that point, based on your due diligence time frame. No, joking.
Yeah, right.
But I mean, are you guys okay with talking a little bit about this Atlanta deal, or it's up to you if you don't want to?
Yeah, we can just skirt the the topics. We've been cultivating the market there for quite some time, and just kind of getting to know the area. And one of our since we're moving out of the DFW market just because of how hot it is, one of the things we want to look where obviously not everybody's looking. It's important. The worst thing we could ever do for our investors is go into a hot market and a hot deal, and then for things to change. I really like a slow organic growth, grow like an oak versus growing like a weed, and to look for solid basis. And the fundamentals seem to be there, as Tim talked about. So we've been looking around, and we did find a great 284 unit gated community that we have a very fast due diligence period, 14 days, and we've executed that. Tim and I were out there a couple weeks ago now, and so we're moving.
Feels like
moving rapidly. Ago. Does it? God, we're moving rapidly down that course, and we're doing well. We really like the property. As Tim said, there's no interiors have been done. The owner did a great job with the structural components, but there's just a lot of low-hanging fruit that we feel that we can go in and just kind of spruce it up, and we like the market a lot. So.
Okay. And you guys gave me the quick background on how you found that opportunity. Do you mind sharing that? And I don't remember the entire story, but it was a good one. I think a lot of it revolved around continual follow-up. It was a broker that brought you the deal, but I'll let you tell the story because I think that really is one of the more important parts of this business is the relationships that you build. A lot of that will deem whether or not you get access to good opportunities like this. So,
one thing I've learned is this business is all about relationships, which is amazing to think about. That they obviously have to get to know the buyer. We were out of town buyers from Dallas, and they didn't know us from anybody. So we spent a lot of time talking to them.
To the brokers or to the owners?
No, to the brokers.
Okay.
Getting to know all the brokers in the market. So we visited the market a few times, met with brokers, all the big players in the market, and even some of the smaller ones. And the other thing that we did is we spent time with management companies. That's obviously because we don't manage, a critical part of the component and developing a relationship with kind of the big management companies and ultimately deciding on which one it's going to be. Because they're really your boots on the ground, right? I mean, we'll be there a bunch of times per year, but you've got to have confidence in the management company and what they're going to be able to do and can they execute the business plan. So In the case of Atlanta, the management company that we chose, it's fairly large. They have about 22,000 doors in the Southeast. The nice thing about it is that one of their founders is kind of known in the market as a deal killer, in a very positive way. The brokers, think the world of her, highly recommended, but, she is also has, is known as somebody who, if she doesn't like the deal and doesn't think that they can get it done from the management side, she's going to speak up. Mm-hmm. Yeah, she's going to speak up. And we immediately loved that about her. I mean, that's what attracted us to their firm probably, is that she's very, very candid, and she'll tell you if they can do it or not. So, yeah, the business is all about relationships. We're cultivating same practice in Charlotte, and then I made a comment about Indianapolis. Tom went to residency there in Indianapolis. He knows the market really well. We've got a good friend there who's a residential realtor, but we've spent, several hours talking to the brokers, to the bankers, to the lenders up in there, just to develop a relationship with them that we're visiting there in June or in July to start looking at deals. Those markets are not nearly as competitive as the Dallas-Fort Worth market. We've kind of talked about that to nauseam, but we like these other markets that we're starting to stick our nose in.
In this Atlanta deal, though, I believe, again, correct me if I'm wrong, my memory is not the greatest, but it's still pretty good today. It fell out of contract. It was actually in contract with another buyer, and it fell out. And then you guys kind of got the call and said, hey, if you guys have an interest, you better get here right away. And you guys pretty much jumped the plane in a matter of a day or two. Am I butchering that story, or is that the truth?
Tim?
Yeah, no, you actually nailed it.
Okay.
Yeah. Sorry.
I thought I lost you guys for a minute.
No, there's a bit of a delay. No. You actually nailed it there, that it was in contract and it fell out. I think the original buyer had some equity challenges, so it fell out of contract. And, the relationship that we had been cultivating with the broker, he immediately picked up the phone and said, guys, I've got this deal. It's off market. Are you interested? And then we immediately, sprang to action. And, we're very, very nimble.
You have to be.
Of us.
You have to be in this business.
You have to be. Yeah, and you have to be very quick. Yeah,
exactly. Very decisive. If you're going to spend a week to talk to your buddies and your friends and your pals and your mentors and your people at your real estate investment club forget about it. It's gone. It's gone, especially in this type of market.
We're super nimble.
Yeah,
yep, exactly.
Yeah, we were actually sitting in Houston at the George R. Brown Convention Center, and what we did as part of Nepali Capital, and part of the book that I wrote, which is dealing with translating high income to high net worth. We were down at a physicians conference in Texas, and there's about 2,000 physicians, and Tim got to know doctors very, very well there. He'd never been around that personality, so he was indoctrinated on that. We sat at lunch, and we found out we were going to need to do this due diligence very quickly. So literally on a Friday afternoon, sitting at lunch, we're booking tickets for Monday 5 a.m. flight to Austin. So, I'm sorry, not to Atlanta. So. See, that's sometimes that's what it takes, is just a commitment, with air travel and everything else, and the world's a much smaller place. So
yeah, absolutely. Now, I want to talk about a few things. I don't want to make this seem like it's easy to those that are listening. There's a lot of people that listen to our show that are new, that are getting into this business, and we have a lot of seasoned investors as well. But I very much dislike those that, they speak to all the pros of this business, of being just a successful real estate investor. They don't talk really about the challenges or the struggles that it took to get there. And you guys have been very successful. You both come from a very successful background prior to getting into real estate. But talk to me about some of the challenges that you guys have faced. So, forget about let's talk about post development deal, that apartment development deal that you guys did in Texas. Let's talk about from that point to where you are today. Some of the challenges that you face and how you've overcome them. I mean, I'm sure there's been a few at least, right?
Oh, absolutely, without a doubt. I think it takes a lot of perseverance, and if you think you're, somebody novice and just starting out in real estate, I think the first thing is, you've got to get in the game. I mean, that's really important. You can have a lot of analysis, kind of the analysis paralysis people talk about is. At some point, you need to take a little bit of money, and that will force you to learn and educate if you've got actual skin in the game. But I'd say in the market and how the economy is changing, and maybe the perception of Wall Street, I think, has changed quite a bit. And the juggernaut that is Wall Street and the banking industry has gotten kind of a pop culture bad rap. So I think people are looking what has traditionally been an alternative investment is becoming more mainstream. And as you hear more of the rental segment, the millennials and the baby boomers getting older, there's more pressure towards these things. And I think one of the biggest things the mistakes you can make is thinking that you're going to, number one, hit a home run the first time. And number two, quitting too early. I mean, we probably look at, I don't know, we keep a tracking or running tab of all the deals that we analyze, how many we offer on, how many are accepted for offer, and how many we actually close. That's probably since the beginning of the year. Tim, what would you say, 90 deals we've probably analyzed?
Least, probably, wow. Yep, at least.
That's a lot.
to put what, 5, maybe 10 LOIs in. And for those LOIs, and for those that may not know, LOI is a letter of intent to purchase the property. And of those, we've probably gone to contract negotiations twice, actually 3 times. So 3 times, and we've fortunately, once we go to the contract phase, we are sticklers on if we say we're going to do something, we do it. And we've gotten, fortunately, all the way through those contracts, and we've closed all those properties. But that just goes to show you there's a very low percentage. You have to be willing to go the extra mile, to turn over all the stones, and to look at everything to be able to find what's going to meet your investors' parameters and in your own.
Yeah, I would also say that you have to build your team, right? I mean, that is a key critical part, is to develop your team around you, whether it's analysts or, excuse me, allergies this morning, analysts, your, relationship with brokers, relationship with lenders. You have to build a solid team. And I think that, what we've been super responsible about is to think small, to grow big, and be very responsible in how we're growing. There have been many deals that we could have done that at the end of the day just would not have been, good for our investors. And we always put our investors first, way ahead of us. Yeah. We're always thinking about the right returns.
Like we talked about earlier, is we would have put our own money in that deal, so why would we offer it to somebody else?
Yes. Yep, I love it. Okay. Well, guys, so you've been at this now. How many? So what? Tom, you've been at this now from that development deal. That was 2009. So what? 9 years.
About
from 9,
a multifamily
space. Okay. And then Tim, you got into this. You really started getting your hands into the business. How many years ago?
Yeah, I mean, really about a year and a half ago.
Okay.
I obviously was on the side in the hospitality business with new resort real estate development, but in multifamily about a year.
Okay. So I'm going to ask you guys both this question. I'd love to get an answer from both of you. Tim, you've been at a year and a half on the multifamily side. You strictly focused on that. And Tom, 9 plus years. Knowing what you know today, if you can go back to year one when you're just getting involved in the multifamily space, what advice would you give yourself? And Tim, I know that's only back to year one. That was only a year and a half ago. But go back to day one maybe for you, Tim. Right. But give yourself some advice, knowing what you know today, what you've been through, acquiring the number of units you've acquired. What advice would you give yourself?
I'd buy more. Without a doubt. I would have pushed it so much harder than what I originally thought I could. Especially when we talk about single-family homes, I was purchasing those without even looking at them, on the HUD foreclosure website, and thinking, well, this isn't going to work. And at that time, you had a lot of, flippers and things in the market. You still do, but there were several of them I turned down that I should never have turned down. I mean, it was just, and you look to see what's happened over the decade. We're in an unprecedented time in real estate growth with not only with interest rates being at an all-time low and cap rates falling. That's never going to, not to say it's never going to happen again, but at that time period, even being lackadaisical, you could do very well, and you had less risk. Now, I think it's you really got to look at things because we're on the precipice of some change. I don't know what that change is, but you really got to look. You got to look a little bit further on down the road and say, okay, what happens if when interest rates go back up, cap rates have to follow, right? Because we can't leverage as much. So you just have to look at it and realize that to protect your downside is really, really, really important. But yeah, if I would have told my old self there, I would have been buying like crazy, like it was on, fire sale.
Yep. No.
Yeah, advice. And Kevin, I would probably say start earlier than I did. Be opportunistic and learn more and faster, move quicker, be more nimble. That's what I've learned a lot about this business is, there's also just a ton of education out there. But, a day missed is a day lost. So, move quicker.
Great advice. And we're about to wrap things up here, guys. And I want to make sure that we showcase, Tom, your book that you wrote. So do you want to take a few minutes and talk about that and tell our listeners how they can learn more about that book and get a copy of it?
Yeah, absolutely. So it's on Amazon and Barnes & Noble. It's called The Passive Income Physician, Surviving a Career Crisis by Expanding Net Worth. And so I started this book really because a lot of physicians, as I was doing this, tend to be, very one-track mind, medicine only, and as you know, professionals and the profession's changed so dramatically in not only the last 10 years, but 20 years, and that we're kind of human capital. We work for other people. A lot of us tend to be almost just in hourly employees now with really no tax write-offs. I mean, the days of having your own practice and owning the building are pretty much gone. And so what I've learned is we go to wealth advisors, to any number of large houses that do take a percentage of that, and they do very well. But at the end of the day, that's a sales job. And there's thousands of financial service advisors out there. But how do you cut through the weeds and see what's real and what really you're getting? What's your cost basis for this? And what I was finding is everybody talks a good game, but they're not held to a standard, which is really funny. When in the medical practice you're accountable and you're expected to meet perfection. When in the financial industry, they say, well, I can't control the stock market. And so I was a little soured on it. And so that's really what started me down the real estate road. And I had several friends and colleagues that were interested that became my foundation of my initial investors. And I really wrote this with them in mind. And as I started to meet people, the story was kind of birthed from my being an absolutely horrific high school student to joining the Navy because I couldn't have gone to, an internet school at that time. It was that bad. I mean, I think I scored a 700 on my SAT when all my friends were, asked me what section that was on. I said, no, that was the entire thing. So it's kind of a point where I got and then becoming a physician and realizing that you get to see both sides of the table. And so the book has done very well on Amazon. It was number one when it first came out in the real estate investing space and has just really opened eyes. And I didn't do it. Nobody writes a book for the royalties or money. It's really more about, it was a catharsis for me to explain my story and what changed my life and how I've turned a really disappointing career, not a career choice, because I'm very passionate about medicine and I still practice about one day a week, but you get to the end of a road which took you a decade to get there. And sometimes you look back and you think, wow, I didn't realize this is what was at the end of the road when I started off, because it's just such a long path. And I find a lot of physicians in that same mentality, that they're really unhappy with the situation. There's a lot of mandates and government red tape that you're dealing with, and patient satisfaction and things like that. So it's really had a niche, and I've enjoyed doing it, and it's really helped a lot of people kind of look at the other side of that. So that would, I'd say, if you Google that. Otherwise, you can check me out. My blog is www.freedomintheblack, and there's some items on there. I've been blogging for other folks more recently. And then, of course, on our website, you can get more information just about Tim and I and our investments and our analyst, which is at Napolicap, which is NAPALICAP.com.
Okay, fantastic,
so
guys.
We're very, very quick to respond. If anybody wants our emails or anything else, it's Tim at Napolicap.com and Thomas at Napolicap.com.
Okay.
Like Tim said, we answer very quickly. So.
Well, fantastic, guys. Well, before we wrap things up, I want to go into our Golden Nugget segment, and this is where we kind of round it out for the day. And I'd love an answer from both if you wouldn't mind. And what one final Golden Nugget of advice or wisdom would each of you like to leave with our listeners that may inspire and motivate them as they progress in their real estate investing careers? And this could be maybe your favorite motivational quote, some core principles that you live by, success habits. I mean, there's no right or wrong answer here.
Gotcha. I would say my thing is dealing with fear, and the biggest thing that I see with people not wanting to do is they're really worried about losing their money. And at some point you have to jump in. I mean, there's no more. I don't see it. I see it as a less risk than the stock market, just because I've got transparency, and we tend to be very transparent about investments. There's a hard asset that's backing it up. It's not buying an internet stock, or anything else that can potentially go to zero. It still can, but it is a tangible asset. And I say at some point you have to jump off the cliff into the water.
Mm-hmm. Nope. Great advice. And then Tim?
Yeah, I mean, I said it earlier. I think small to grow big.
Yeah.
Too many times people are thinking too big. They're forgetting about the small things. So, we're trying to be thoughtful about that. So think small to grow big, no doubt about it.
Fantastic. Well, guys, this has been an absolute pleasure. Thank you for coming on the show. And again, to learn more about Tim and Tom's company, you can visit them at napalicap.com. It's napalicap.com. And guys, that's all we have. So really appreciate your time. Best wishes to all your future successes, and look forward to catching up another time. Okay?
Great.
Thank you very much, Kevin.
Appreciate it, Kevin. Have a good one.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.